Welcome to The Explainer. Today, we're going to follow the money. We're going to see how economists can actually take the pulse of an entire nation's economy, all by tracking the journey of a single dollar.
I mean, just think about that for a second. You've got millions and millions of people buying, selling, working, creating every single day. How in the world can you boil all of that activity down into one number that tells us if things are getting better or worse? Well, that is the big puzzle we are going to solve today.
Okay, so let's dive right in. To get a handle on measuring an economy, you first have to picture how money actually moves. And at its heart, it's not just a bunch of random transactions. It's really this constant circular flow.
So check this out. This is the simplest model of that flow. On one side, you've got households. That's you and me. We provide labor. On the other side, you've got firms, all the businesses. So we work for the firms and earn income, and then what do? We turn right around and spend that income on the goods and services those very same firms produce. So you see the loop, right? Money flows from firms to us as a paycheck, and then it flows right back to them when we buy their stuff. It's this continuous, beautiful loop.
Okay, so here's the really cool part about this whole circular flow idea. It actually gives economists 3 different spots where they can stand and measure the size of the entire stream. And to see how that works, we're going to use a really simple example. Let's imagine a super simple 2-step economy. A farmer grows and sells some cotton for 50 rupees. A cloth maker buys that cotton, turns it into a piece of cloth, and then sells it to a customer for 200 rupees. That's it. That's our whole economy. The question is, what's the total value created here? Our first approach is what's called the product method. Now, your first instinct might be to just add 50 and 200, right? But you can't do that. That'd give you 250, but you'd be counting the value of that cotton twice. The absolute key here is to only count the new value that's created at each stage, what economists call the value added. And this table just lays it out perfectly. The farmer's value added is the full 50 rupees, because, they started from scratch. The cloth maker, well, they sold their final product for 200, but they had to spend 50 on the cotton, so the new value they added was 150. You add the value from both steps, 50 plus 150, and what do you get? A total value of 200 rupees. All right, on to method number 2. This one is the expenditure method, and it's way more direct. This one just asks a really simple question. What was the total amount spent on the final good? It basically ignores all the middle steps and just jumps right to the end of the line. Well, in our little story, there was only one final sale, right? The customer buying the cloth. And they spent 200 rupees. Simple as that. Now, hang on a second. Notice anything? Yeah, it's the exact same number we got with the first method. And that, of course, brings us to our third and final way of looking at this, the income method. You see, every single rupee spent on a final good has to end up in somebody's pocket, right? Either as wages for the workers or as profit for the owners. This method just adds up all of those incomes. So, let's break it down. Say the farmer's 50 rupees of value was split into 20 for wages and 30 in profit, and the cloth maker's 150 of value was split into 60 for wages and 90 in profit. So if we add up all the wages paid, that's 80 rupees, and all the profits earned, that's 120 rupees, what does that give us? Yep, you already know, 200 rupees. So this is the big aha moment, the crucial takeaway. Production, expenditure, and income, they're not different things at all. They are just 3 sides of the exact same economic coin. No matter which way you slice it, the total is always the same. Okay, so now that we've seen how this works with a simple piece of cloth, let's blow it up to the scale of an entire country. When we do that, we get the blockbuster economic number that everybody talks about, gross domestic product, or as we all know it, GDP. So here's the official textbook definition, and trust me, every single word here is important. It's the total market value of all final goods and services produced within a country's borders during a specific period of time, usually a year or a quarter. It's the grand total of everything we make and do, from cars to coffee. And in the real world, the most common way we actually calculate this number is by using that expenditure method we just talked about. This gives us one of the most famous formulas in all of economics. GDP equals C plus I plus G plus net exports. Let's just quickly break that down. C is for consumption. That's pretty much all the stuff we, as households, buy. I is investment, which is what businesses spend on new equipment and buildings. G is government spending on things like roads and schools, and X minus M is just our exports, what we sell to other countries, minus our imports, what we buy from them. You add all that spending up, and boom, you've got GDP.
Okay, so GDP is the big headline number you always hear about. But to get an even sharper picture, economists actually use a few important variations.
One thing that trips a lot of people up is the difference between GDP and GNP, or gross national product. But it's actually pretty simple. The easiest way to remember it is this. GDP is all about location. Where was it made? GNP is all about nationality. Who made it? So, was it produced inside the country, or was it produced by one of the country's citizens or companies, even if they're overseas? Next up, what's the deal with gross versus net? Well, gross is just that big grand total of everything. But think about it. To create all that value, our machines, our tools, our buildings, they get a little worn out, right? That wear and tear is called depreciation. So when you subtract that cost of depreciation from the GDP, you get the net domestic product. It's a slightly more honest look at what we've really gained. All right, so we have this incredibly powerful tool. We've got all these specific definitions to make it super precise. But what does this one single number really tell us about our lives? The fact that we can take all of that, all the production, all the spending, all the income, and get one single consistent number for this gigantic, complicated system it's a remarkable feat. But it also leads us to the final and maybe the most important question. We know how to measure the size of the economic pie, but does a bigger pie always mean a better life for everyone? What about things this number doesn't count, like our free time, the health of our environment, or inequality? What does this one powerful number completely leave out? That's the question we'll leave you with. Thanks for joining us on The Explainer.